Channel 5 and Frontier TV Channel 6098, or at www.whctv.org. The meeting is also being recorded for on-demand viewing, which will be available on the town's website. Because of the virtual format, there are some special rules and procedures that I need to cover before I begin. First, I ask all participants to please mute your devices when you are not speaking. If you wish to be recognized, please raise your hand and I will call on you in the order I see hands go up. If you are participating via audio only or I do not call on you and debate is ending, then please unmute your phone and let me know so that I may recognize you. Second, main motions will be made by me and no second is necessary. We will proceed immediately to debate. These include motions to adopt, receive, or approve business items. Subsidiary motions still require a second. These include motions to amend. A member must be recognized before making a subsidiary motion, but any member can second a motion by just unmuting their line and saying second. Third, pursuant to Executive Order 7B, all speakers must state their name and their title each time they speak. Fourth, because of the difficulty in tallying voice votes on a video conference, I will require that all votes be taken by roll. Fifth, a reminder that if any participant has a problem with their connection, you should immediately call Lori Carney. She will let me know and we will recess the meeting while the problem is resolved. If it cannot be resolved quickly, we will ask you to call into the meeting using a phone and to participate via audio only. I want to thank everyone in advance for your patience as we adhere to the aforementioned requirements. I am now going to ask Lori Carney to call the roll. Lori?
Okay, sure. Nancy Dean.
Here.
Lazaro Guzman.
Here.
Alan Lebo.
Here.
Ethan Goldman.
Here.
Brittany Birmingham.
Here.
Peter Privitera.
Here.
Mayor Cantor.
Here.
Chris Kachmar.
Here.
Rick Ledwith.
Here.
Lee Gold.
Here.
Becky Sielman.
Here.
And we have Mary Fay joining us as well. And Jennifer Evans is recording for us. I think we're all set, Nancy. Is there anyone else participating whose name I have not called? Okay, all right, Nancy.
Okay, great, thank you. Okay, Nancy Dean, again, good morning once again. We do have a special meeting this morning. I want to thank you again all for participating. We do want to try to stick to a timeline of hopefully 8:45 with a cushion with a formal end by 9 o'clock to accommodate everybody's rest of their days. I do want to make one comment though relative to email protocol. And for those of us who are not well schooled on the municipal side of things, coming more from a corporate background or from other backgrounds that you might have in your normal day-to-day life, there are some email protocols that we need to be very sensitive to here since we are dealing in public information. And one of those relates to being very careful about responding to an email that any one of us receive as part of a group email. We've talked before about the challenges of making sure that as board members we do not have what might appear to be a meeting to transact business, even though it may not be our intention to do so. And in this case, if you if there's a particular question or an ask for some information or some thoughts, if we happen to hit reply all, then we may be inadvertently creating a situation that we have become a public meeting if we are replying to all fellow members of the pension board. So going forward, I'm going to ask that every time you get a request, either from Lori in particular, who oftentimes is the conduit for information or request for information from either me as chair or perhaps Pete as our primary connection with the town staff on the financial side, that you reply only to the person that asked you the question. So many of us just hit reply all, sometimes in error, sometimes I do it too, for other reasons to make sure that everybody is aware. But in this case, if we do that, it does create a situation where there could be a Freedom of Information Act type questions to be dealt with. I have had some conversations with Corporation Counsel in this regard, so they have encouraged me to give us all this kind of kumbaya moment a bit. Corporation Counsel and the Town Clerk's Office are working on some Freedom of Information Act training for all the boards of the town, and we should be hearing some more about that in the next couple months. So with that, just always remember to please just respond to whoever is asking you a particular question. And other than that, I am going to turn the meeting over to Pete, who is helping to coordinate some of the questions that we have relative to the model. Pete?
Good morning, everyone. Privitera, Finance Director for the town. Two things. I thought it would be a good idea if we all got together and discussed some of the requests that were made to Becky. Some of them are very straightforward and simple. Some of them might require more work. And my concern was that, normally the board would approve the expenditure of funds for work that's over and above the scope of the actuary of Becky. This is not part of her contract with the town. Initially, I was thinking that we could use this, we can basically incorporate the expenses of these additional analysis into the cost of the bond issuance, but they're really not applicable because this is beyond the scope of the issuance. This is not part of the decision-making process to issue bonds. This is the investment portion of it. So I'm hoping that two things happen today. One, that we're all in agreement on the analysis that's requested, and Becky is very clear as to what her marching orders are. And two, that the board votes to authorize the expenditure of funds to allow Becky to complete the analysis. And again, I'm sure that it's going to be an estimate, a not to exceed amount or whatever. But I think that as with expenditure of funds, I think the board needs to authorize and approve it, and there should be a record of it, so there's no question moving forward. Are there any questions?
This is Nancy Dean, Chair. I would just reiterate that we need to keep in mind that the expenses associated with these scenarios will be expenses of the plan itself, as opposed to coming out of the proceeds of the bond issuance. So it's similar to the expenses that the plan that we do authorize and approve for legal counsel on particular matters for a pensioner or for a particular participant. So that's another reason for us to pay particular attention to this. Thank you.
I just want to add one more comment. I'm still trying to get a determination whether or not these expenses would be allowable as part of the issuance cost. So just to be on the safe side, I feel more comfortable if the board authorized the work, but if in fact I can include it as a cost of issuance, I probably would, and I would let the board know. So given that, I know that there were a number of questions, and I forwarded the questions to Becky, and I'd like to turn over to Becky to comment on how easy some of them are and some difficulties she might have with other ones. Thank you.
Good morning. This is Becky Sielman from Milliman. Pete forwarded to me some emails that he received from some of you requesting that the pension obligation bond model be modified to explore the long-term impact of several different scenarios with respect to future investment returns. Some of those requests, so let me use some mathematical terminology with you. When we prepare long-range forecasts, We do so in two ways. The first is called a deterministic projection. That is based on a single set of expectations about what will happen in the future. And the second way in which we can do forecasts of the future is stochastic or Monte Carlo, where we're looking at a large number of different scenarios and seeing how that range of scenarios impacts the long-term finances of the plan. In either a deterministic or a stochastic scenario, we are projecting both the plan's liabilities and the plan's assets. For all of our pension obligation bond analysis that we've prepared for the town, we used a deterministic projection for the plan's liabilities. That is, we said we have a set of actuarial assumptions that we use when we calculate the funding requirements for the plan, and those assumptions include what we expect will happen in the future with regard to pay increases, turnover patterns, retirement patterns, disability rates, how long people will live, what annuities people will elect when they retire, all of those assumptions. For all of our analysis, our long-range forecast of the plan's liabilities assumed that the future would unfold exactly in accordance with those actuarial assumptions, so that no matter what was happening economically, the members of the plan would still behave exactly in accordance with our assumptions. However, when we projected the plan's assets, we did both deterministic and stochastic projections that took into account that the investment performance from year to year might be very different from our long-term assumption of 6.25%. So when we talk about different scenarios that we might run, we're always assuming the same pattern of emerging liabilities, but we're varying what the investment returns will be. For the analysis we did for the town, we ran 10,000 scenarios for the next 30 years with respect to the investment returns of each of the different asset classes in which the plan's assets are invested. So we have a 30-year projection of core fixed income and 10,000 scenarios, 10,000 variations of that. And similarly for large cap stocks, small cap stocks, foreign equity, emerging markets, real estate. So for each of the asset classes, we have 10,000 scenarios about what the next 30 years might look like. And that enables us to kick the tires on what might happen going forward. I mean, if there's one thing we know about the future, is that we don't know what the future will hold. So looking at a large number of possible outcomes enables us to inform the town about how those different investment return scenarios might impact the town's contribution, the funded status of the plan, and other measures of the pension plan. So returning to the emails that Pete forwarded to me, some of them were requests to, instead of having 10,000 random scenarios about investment returns, to build into our model a set of very specific scenarios. What if this, the next 30 years held this particular sequence of returns or that particular sequence of returns? And so I didn't count them all up, but there's maybe half a dozen different suggestions for different scenarios. I have the email. Let me just, so for instance, and this was from Al, sketched out 5 different scenarios, and I won't go through all of them, but the first one, for instance, is immediate 50% drop in equity values followed by 8% annual equity growth per year. Bond growth can be 3% annually, and money market can be 50 basis points annually. So that's what I would call a very specific deterministic scenario. What if this specific sequence of events unfolds over the next bunch of years? Our model is built to handle that sort of what if pretty easily. I would need to do a little bit of work to translate the particulars that Al laid out into rates of return on the different asset classes. So Al, you talked about equities and fixed income, but we've got 1, 2, 3, 4 different flavors of equities, and so we need to just iron out the details of what you'd like to see in terms of large cap, small cap, foreign developed and emerging market equities, so that we can load that into our model. So our model assume the inputs to the model are rates of return, and rather than changes in value. So we just need to get synced up on that. Those are, once we iron out the little details, are pretty quick and easy for us to run. And if we're doing a bunch of them at once, it's much more cost effective than if we get them in dribs and drabs. So in the interest of saving your money, I think the most efficient way to tackle running those kinds of scenarios would be to make sure we know in advance exactly what we're going to do, and then we can get to work and do all 6 or 8 or however many you want to see. Any questions about running the deterministic scenarios that have been requested?
Yeah.
So
yeah, this is L.L.C, member of the pension board. Becky, in talking with you and your partner earlier, or colleague earlier, I understood that you had 3 categories of investment, those being equity, bond, and money market. If that was mistaken, I think if you and I could just go over exactly what the specific categories are, I would be happy to rephrase any of these, to give you an Excel file showing you the exact request that I want by investment type. So I think that's just a matter of you take my file, stick it in the program and run it. I don't think there's anything more to it than that.
yeah, this is Becky again. Yes, we have actually a total of 15 asset classes built into the model, representing the 15 asset classes, not only what you're invested in now, but things that your investment consultant, Chris Kachmar, thought you might conceivably consider. We are using cash, core fixed income, and I can tell you what indices were used, to match up with those, so that which might be a helpful way of looking at them. Large U.S. large and mid cap stocks, U.S. small caps, foreign developed equity, emerging markets equity, and private real estate, which is what your target allocation references right now. So those are fairly straightforward. And, depending on how many scenarios you ultimately come up with, and Al, yes, it is the easiest, most efficient thing for us to do is if you provide a spreadsheet with the specific 30 years worth of returns, and then we can fold them into the model. The other type of analysis that you asked about was using 10,000 scenarios from sources other than ours. And you referenced the National Association of Insurance Commissioners, which has 10,000 scenarios that are used for modeling variable annuities. And there's a second set of 10,000 scenarios produced by Conning and Company. That's more difficult. We'd certainly be happy to embark on that process. We would need to get comfortable with the underlying construction of those scenarios. so that we can rely on that output and understand it as the basis for our work. And that would take a lot more time and effort to accomplish. So it's therefore a much more expensive undertaking. With all of these, you know, I've told Pete and Nancy this before. I'm happy to spend your money. Don't get me wrong. And there's nothing I like better than number crunching all day long. And it's a really cool model and it's fun to use. But you need to consider what you will do with this information once I provide it to you, and hold that in the balance with the cost of producing it. So how, in what way is this actionable information for you, and what will you do with it once you have it?
Alan, go ahead.
L.L.C, Pension Board. So Becky, what I was trying to convey in the email was that you know, I work in variable annuities. I know that the NAIC has produced scenarios for our use, and the Academy has produced scenarios as well. The NAIC is considering changing to some scenarios that are produced by Conning. I don't work in the pension industry. I assume that the NAIC, the National Association of Insurance Commissioners, has produced a similar type of thing for pension purposes. So you're shaking your head, so
I'm not aware of. No, I'm not aware of any. You know, the NAIC doesn't have any relationship with pension plans. It's possible that the NAIC has something of the sort that's used for not variable annuities, but pension risk fixed annuities that are used in the pension risk transfer market for use by insurance companies in their work with annuities, but there is nothing of the sort that I'm aware of for pension plans.
Yeah, well, okay. So I was hoping that that the Milliman was in your pension consulting, that you have some sort of regulatory body has produced scenarios that you could simply substitute in.
No.
Okay. All right. If that's not the situation, then I guess yeah, what I would want to be doing is like, well, I guess like I said, these are produced and are out there in the public domain. I don't know if there's any kind of restrictions. Particularly like Conning scenarios might have some restrictions on their use. I don't believe the AAA scenario, the American Academy of Actuaries, would have any restrictions on use of their scenarios. So if we discussed how to sort of take those scenarios and convert them so that I could convert them for your use and just simply feed them to you, you know, maybe we could work something out that way.
This is Nancy Deans. I would think that might take some time, but as a first step, Alan, in terms of what Becky proposed, if you're able to provide her with the 14 or 15 asset category returns for her to use into the model, are you able to do that so that you would be satisfied with that part of your request?
So I had requested 5 scenarios. I believe Lazaro had a 6th one.
Just asking you. I want to do. We have to come to consensus here. So given that this format, I can't judge. I can't see everybody at the same time. I want to just go specifically, if I might, Alan. Thank you.
Yeah. So, so the point I was going to make is that I can take all 6 of those scenarios and format them how Becky needs them. Becky and I are going to need to have some conversation to exactly how that needs to be formatted and what the specific indices are, proxy indices are. But I can certainly take those 6 scenarios and make them readily usable for Becky. The separate, the 10,000 American Academy scenarios or something like that, that may take some more time and be some more work to get that produced.
Lazaro, do you want to have any comments at this point, since you did respond to the questions?
Yeah,
Request for information.
sure. Thanks, Nancy. Lazaro Guzman, pension board member. I did have one specific scenario request, but I guess as we think about running additional scenarios, what I thought would be helpful is, maybe just a quick explanation of kind of in the 10,000 scenarios that have already been run. If you can speak to sort of, did you include details? And then I think one of the, high level concerns that we have is we invest all the proceeds from the pension obligation bonds, and in the very first year, we have a pretty significant negative return, compounded with, then we're going to be drawing down from the pension fund. And maybe some of that has been looked at in the 10,000. So if you can speak to that, and then I'll get into my specific request.
Mm-hmm. This is Becky. Would it be helpful to show you the model and just walk through what it does and show you a couple of random scenarios drawn from the 10,000?
I think it would be helpful. I'm not sure if that was sort of what we had envisioned for this meeting, but yeah, it would be helpful, maybe not the random ones, but some that would sort of consider, early on a very negative return.
Okay. Well, in that case, let me just pull up.
And if you've got something in the kind of negative 35 to 50, so I had talked about a negative 35% equity return in the first year. I think Al's got one scenario where it's negative 50, and then he talked about what happens in the following years. But if you've got something in that range for the first year return, that would be helpful.
Mm-hmm. So can you see my screen?
I can.
Okay. So let me move to the kind of the guts of the projection. This is a deterministic projection. It happens to be the one where the investments earn 6.25% each year into the future. So you can see, going from left to right, we have each valuation year, which determines the contribution for the fiscal year that ends 2 years later. We have in this green column here the market rates of return for each year. So that's in the 10,000 scenarios, that's looking at the specific returns for the different asset classes and aggregating them up based on your asset allocation policy. We have the accrued liability, which is growing over time as active members continue to earn benefits. It grows over time with interest as well, and it goes down over time as retirees receive benefits. This accrued liability projection is the same for every single scenario. That's a deterministic projection of the accrued liabilities. The actuarial value of assets, so recall actuarial value includes the 5-year asset smoothing that we use to dampen market fluctuations. First, we project the market value of assets and then determine the actuarial value of assets. We didn't have enough real estate on the page here to show all of that, but we're projecting the market value of assets. We have a deterministic projection of the benefits that will be paid from the pension plan each year, the employee contributions that will go into the pension plan, administrative expenses that are paid out of plan assets, the town's contribution going into the pension plan, and investment return, which is based on the year-by-year market rates of return. So all of those go into projecting the market value of assets at each year in the excuse me, in the future. And then we also layer on top of that the asset smoothing to determine the actuarial value of assets. You can see that in the first 2 fiscal years after the pension obligation bond is issued, that the investment returns are a little bit lower than 6.25%. That's because the plan is to gradually fully invest the proceeds of the pension obligation bond over an 18-month period. So the portion of the proceeds that have not yet been fully invested will be sitting in cash or some very safe short-term cash-like investment vehicle. And so there will be a temporary depression of the investment returns. It's really a hedge, right? You're pursuing a conservative strategy to protect against putting all of the money in at once and then having the market immediately drop. And as with any hedge, there's a cost associated with that. And in this case, it's that you are leaving some potential investment returns on the table should the market really rise rapidly. So we have liability and assets. The difference between them, of course, is the unfunded accrued liability, and the ratio of the one to the other is the funded ratio. Based on the plan's funded ratio and the normal cost, the cost of benefits being earned each year, we can determine the actuarially determined contribution. You can see that the actuarially determined contribution drops very considerably the moment the plan is fully funded, because you still have to contribute the normal cost, but you're no longer including in the contribution that very large number to pay off the unfunded accrued liability. We have the Privitera perfectly conceived reserve fund balance, for which he's going to get some Nobel Prize for municipal finance. But the reserve fund will be seeded with the actuarially determined contribution you otherwise would have made in fiscal 21-22. And it will be drawn upon in circumstances when the actuarially determined contribution goes up sharply from one year to the next. So it is providing budgetary stability. In the very first year, we expect it will be drawn upon because the actuarially determined contribution, which heretofore has been based on an interest rate assumption of 6.99%, instead will be measured at 6.25%. And that's a pretty big drop in interest rate, and therefore a pretty big increase in the contribution. And the reserve fund will be drawn on in that first fiscal year in order to provide the town with budgetary stability. So those are the amounts that would go into the pension plan. The town would also be paying debt service. This is based on the maximum issuance amount, the maximum amount that the town council authorized. The final amount may be a little lower. It's also based on a 3% bond rate, and based on current market conditions, we expect that the bonds actually will be able to be issued at a somewhat lower interest rate, which would, of course, lower the debt service. So the all-in cost to the town with the pension obligation bond is the actuarially determined contribution less amounts that are being paid from the reserve fund plus the debt service. And that's this column shown here in red. But we can also look at, for this same exact scenario, what would the town's cost be if there's no pension obligation bond? The plan is not immediately fully funded, but rather gradually moves from its 41% funded up to 100% funded over time. And those are these purple numbers. In the final column here, you can see is what is the impact on the town's cost with and without the pension obligation bond. At the very bottom of these columns, so we have 30 years worth of projection here. At the very bottom of the page here, you can see that we've also calculated the net present value, the value in today's dollars of the town's costs over the next 30 years. So we have it's a way of having a single metric that incorporates all of the next 30 years worth of cost to the town, both with and without the pension obligation bond, so that we can have some sense of whether the town comes out ahead or behind by having issued the pension obligation bonds. Now, this is for the one scenario that we are absolutely certain will not happen, right? Which is that the investments earn 6.25% year in and year out. So the 10,000 scenarios that we ran just represent 10,000 randomly generated market returns that start with each of those asset classes. And we have a set of capital market assumptions that include the expected return for each asset class and the riskiness of that asset class, the standard deviation of returns. And it's just sort of a straightforward exercise in statistics to generate 10,000 times 30 years worth of random returns for each of those asset classes. We can take those 10,000 times 30-year outcomes and aggregate them across the asset classes based on how much money you have invested in each asset class to come up with a weighted return for the portfolio for 10,000 scenarios times 30 years. And then we take each of those 10,000 scenarios and run them through this analysis. And so, for instance, just randomly, if I plug in, and I'm just picking random numbers. I never remember what they are from one time I opened this to the next. But here's scenario 2000. You can see that there's some years with negative returns. There's some years with very positive returns, and there are years with returns that are all in the middle. You can see from the graph on the upper right that the market returns are just gyrating around. This isn't any past period. It's just a randomly generated scenario about the future.
But
for this particular set of returns, they're more good years than bad, particularly in the future. There's this nice long set of really good returns early on. So the plan in this scenario gets to be somewhat considerably overfunded. And even though there are some negative returns scattered throughout, they're not enough to drag the plan down into a poorly funded position. But there are some bad scenarios in here.
And maybe so that's helpful, Becky. Thank you for that. And just in the interest of time, so I get that there's 10,000 scenarios, and what I'm trying to get at is there's 10,000 scenarios, and we're asking for more scenarios. But I think keeping in mind that we want to look at the worst case, and I think you might have sent the worst case, but if not, if we could have what the model kind of picked out as the worst case. High level, how are you in what you're sending us? Are you modeling the tails in whatever distribution that you're using? Are the tails part of that worst case scenario? Those worst case scenarios, and then I think in 10,000 scenarios, you probably have some scenarios already where you've got some very significant drops in the market early on. So just looking for confirmation of that and what sorts of drops were modeled early on. So that way, we get some comfort that, we're asking you for additional scenarios, but maybe in these 10,000 already, a lot of this has been vetted pretty well. That's really what I'm trying to get at.
Mm-hmm. This is the way in which we take the results. I've changed to a different page of the model. This is how we visualize the range of outcomes for the 10,000 scenarios. So here on the left-hand side is that same metric, the net present value of the town's cost over the 30 years. And the color coding is the light blue is the fifth percentile. That is 5% of the scenarios. So here, net present value of cost, a low number is good. So the best scenarios at the bottom of the graph. The fifth percentile rather, is this light blue number. So 5% of the scenarios are this number or lower. The median is the 50th percentile. That's the middle of the road. The outcome is as likely to be above that or below that. And the orange number at the top, the 95th percentile, 5% of the scenarios are higher than that or worse than that. I haven't sought out the single worst scenario. I think the ones that we sent over to you that were really pretty bad were at or near the 95th percentile. There are some honestly incredibly awful, I hope I don't live through them kinds of scenarios. And you're quite right that the worst case scenarios are the ones where the worst investment returns are early in the 30 years, so that there's an immediate drop in assets. Those are worst case. Having significant market drops only towards the end of the period are not nearly as harmful in terms of generating high cost to the town. So you know, the biggest fear, the biggest risk with issuing a pension obligation bond is that the moment you've fully invested the proceeds, the market crashes.
So Becky, if I understand this graph right, we're excluding the tails, like, so we're excluding the tail, the upper end of that, where it costs the town the most. That we don't go that far. So, you know, I know in the past when I've done this, sometimes we have a separate slide where we show kind of the worst, you know, that tail. So if, you know, what are the worst case scenarios, and maybe not a specific one, but yeah, I think it'd be interesting to kind of know for us what, you know, what that range is. And if, you know, you had a similar graph, that would be fine. We don't have to go through all this now necessarily.
If you just close your eyes and don't look at this, I can at least tell you how bad is the biggest number. I'll just take the maximum value is 1212. So if you can imagine that somewhat north of 976, there's a number that's 1,212. And that's the worst case scenario with the pension obligation bond. But note that, I don't know where my, without the pension obligation bond, you can see we've stored a whole lot of different scenarios here behind the scenes in the model. The worst case scenario is equally as bad, not equally as bad, is still very bad. Without the pension obligation bond, it's 10,072. So, you know, a very bad scenario is a little bit more costly for the town with the POB than without, but either way, it's really bad news for the town, sort of irrespective of if you have the pension obligation bond. You know, the worst of the 10,000 scenarios is going to be very bad news for the town no matter what. And quite frankly, an economic scenario that you know, that 10,000, that worst one of the 10,000 will wreak havoc for way more than just the pension plan costs. You know, it involves things, I don't know, 5 or more years of negative investment returns in a row.
Yeah, and so I think, you know, to the extent that, and again, we don't have to go to specific examples, but in the worst case scenarios, you know, I was hoping, I don't know if you had a feel for, you know, what sort of negative returns are we looking at in the first couple of years? Are they sort of in the 35 to 50? Just to put us at ease that as we sort of think about additional scenarios, that some of these things that we're concerned about, I went into this thinking they're probably already in the 10,000 in some form. And so that's kind of where I'm still, I think they are, and I think we still want. I don't want to say we don't want to do additional scenarios, but I did want to get a better sense for what's already in the 10,000, so we can limit the amount of additional work that we're asking for.
Yeah, I randomly stumbled across scenario 7,000.
Yeah.
You can see that the next bunch of years, I mean, this is think about this. There's this one double digit year here at 13.69, followed by 7 years of either negative or just barely positive returns. And then there's more bad news later on. So this is, in this scenario, even with the pension obligation bond, the funded ratio would dip back down into the 50s, and the net present value of the town's costs is nearly, let's see, 1,000 million, a billion. So, this is certainly one I don't hope to live through, and this isn't the worst case of the 10,000.
Becky, is the term, we use 30 years. I don't know why I thought I heard that the term of the bonds was 25. Is it 30 or 25?
25. The bond is 25 years. We built a 30-year projection because the town could have issued a 30-year bond. And some of the scenarios we looked at, in fact, were, should the town issue 30 or 25 or 20-year bonds? And town settled on 25 as the sweet spot.
Okay. I do have a scenario, a very specific scenario. We can work on sending that over. Just high level, it was, my scenario is where we experience basically the returns from 2008 and then onward, through the current. And if we need to kind of project that out, because it's a 25-year projection, after from 2008 to 2020, we can use actual returns. And then beyond that, we can use stochastic, random returns if you can do some sort of hybrid.
Mm-hmm.
And what I'd like to see is where we have the worst return, a 2008 type return, once we're fully invested. So we go through our dollar cost averaging, and as soon as we're fully invested, that's when we get that 2008 like return, and then we kind of model the remaining years. So just out of curiosity, but those are all the questions that I had.
Yeah, we did build into the model the ability to plug in the West Hartford pension plan's actual returns over I have a history going back to 1994 of this plan's actual returns. And 2008, I mean, you had a year with a negative 9.2 return followed by a year with negative 17, but then it was followed by 2 years, a 15% return and a 23.5% return. That scenario wouldn't look bad.
Okay.
Right? It was awful at the time. It gave Chris high blood pressure and shaved years off his life. That's the male. It's not hereditary male pattern baldness. It's the consequences of being an investment consultant. But as we have seen many times when the market has had a significant dip, it's been followed by a significant return. The same is true with the dot-com bubble. This plan had 4 years in a row of disappointing returns. So it goes before the dot-com bubble, but 0.8%, negative 0.9%, negative 4%, negative 12%. But then the following year was 19.9. That scenario would look a little bit worse, frankly, than 2008, 2009 because of the prolonged nature of those negative returns.
That's very helpful, actually, and so if you can show us that'd be great. And if it's not that bad, then that kind of confirms that we would have gone through one of the worst periods in financial market history, and it wouldn't have been that bad had we borrowed these bonds or issued the bonds and kind of gone with the plan. One last thing in terms of, something you said about having this information and how would we use it. One of my concerns, and I'm not sure, sort of one of the things I'm still struggling with is the dollar cost averaging. I'm a big believer in dollar cost averaging. One of my concerns though with it is 6 quarters, right from the get-go, we're sort of giving up a spread of, if we're paying 3% on the bonds and we're in short term earning 0.5%. So, right from the beginning, we're sort of giving up about 2.5% on whatever's not invested. So I'm not sure if there's a quick way. I'm not sure if there was any modeling done to say the 6 quarters was optimal, or if it was just not modeled and we sort of said, well, that seems like a good idea. And again, not to give you too much work, but maybe we can think about this a little bit more. But I'm sort of thinking, again, dollar cost averaging is great, but 6 quarters, you're already paying interest from day one. Had we been fully invested on day one, not that that's necessarily the way we'd want to go, does that make things look worse or better in terms of probabilities? And I think I want to think about things a little bit more before I give you something very specific. But I do think we want to use some modeling to sort of validate 6 quarters makes sense, and it should go in the short term as opposed to something like an intermediate term bond where we're not giving up as much. Those are just my thoughts. I don't know if you have any thoughts at this point in terms of that question,
I'll defer to Chris to talk about that. We modeled the 18 quarters. We didn't model alternatives.
Okay.
Yeah, Chris, and before this is Nancy Dean. I want to make sure that both Ethan and Brittany have an opportunity in our limited window today to raise any questions or concern. But Chris, if you want to address that specific, that would be great.
Thanks, Madam Chair. Chris Kachmar, DiMeo Schneider Associates, and I think Lazaro and Alan bring up a lot of interesting suggestions. I think Lazaro, to be determined, right, ultimately what our configuration looks like on dollar cost averaging. When we think about, more than doubling the size of the existing corpus and using a 6 quarter window to do that, it kind of felt intuitively about right to us. Whether we extend that a little bit or shorten it, I think would be the ongoing conversation. And moreover, the exploration of where we actually put those monies, I think, right, is the subject of some more analysis as well. A reminder, right, the yield curve is pretty flat. We're not getting a lot of compensation to extend out the curve a bit, but we can certainly have those conversations and look at combinations of conservative fixed income like investment, right, that might shorten up and tighten that delta a little bit that you referred to.
Thank you.
Okay. Ethan?
Yeah, I had about, can I go or am I good?
Please.
Okay, Ethan Goldman, board member, pension board member. I had 5 comments, so I'll make them quick. One is at some point, and maybe offline, if I could understand how the budget works and asking for money or not. Is there a budget there? Is there available money, or is this incremental? If so, where does it come from? I just like to understand that for my own knowledge.
This is Nancy. Budget for what, Ethan?
Well, Peter's saying we need to take more money to do some of this analysis. Where does that money come from? I'm just wondering, is there money in a budget?
The money, the funding for that will either be a cost of the plan, so it will be taken out of the plan assets, or I think, as with many expenses associated with this type of endeavor, they are netted out of the proceeds of the bond issuance. I think Peter is looking into whether or not the expenses of this additional research can be categorized as a pre-issuance expense, or if we will have to take it out of the plan. Is that right, Pete? Just so that we clarify that before we go further.
Yeah, yeah. Normally we would know what the budget is for the administration portion of this. For instance, we know every year we have to do evaluation, so we plan on it. But any expense that's over and above the normal administrative functions would have to come out of the plan assets. So anything not part of the contract that, for instance, something came out of left field and we had to do an analysis on it, it's not part of the actuarial contract, that would come out of the plan assets.
Okay, so it comes out of the assets. Okay. My second point was I'm sort of going the opposite direction of Lazaro. I'd rather do more, say, I was thinking 16 quarters as opposed to 6 quarters. So look at both scenarios or whatever. That's just, to me, that I'm concerned about the future. I don't know. I assume it's in one of those scenarios. So this is number 3 is what would the 70s look like, just because seeing at the gas pump and also from work, petroleum-based products seem to be definitely going up, and there's inflation there. I am also hopeful that we could get a cash flow from Becky's model, because there's a lot of inputs and outputs. I tried modeling it myself, and I want to make sure that we understand, at least I understand, all the inputs and outputs, particularly where today she said that the first year was coming out of the reserve fund. The numbers didn't look that way. So if we could see that, and then it would also set a template as we go forward, assuming all this goes through, to be able to say, are we hitting our targets or is there issues? And then the final thing was still negative sensitivity to the model, and I think those numbers were run, but almost, where do we have to be to break even with no reserve fund? So I rushed through those because I assume we're short on time, but hopefully that all made sense. I'm good. Okay.
Could I just comment on that?
Yes.
Pete Privitera, Finance Director. With respect to the inflows, are you talking about the actuarially determined employer contribution?
No, I'm talking.
And the employee contributions?
I apologize, Peter. I'm talking about Becky showed a model that has a lot of columns.
Yes.
I tried calculating those columns with some success, but not total. I just want to make sure that when we see numbers coming, we know what the stream is. So if this goes through, you would say, okay, we have we're going to make 6.25%, and here's where it's coming from, and also make sure the investment advisor signs off on that. So then next year at this time, did we hit those numbers, or are the numbers lower? We said we'd be putting this much money in the reserve fund. Did we hit that number? So it's something to be able to model against as we go forward.
Okay. Just a quick overview. I'll be very fast. We're not putting any more money into the reserve fund. The reserve fund will grow based on short-term investments, very reasonable, safe investments. There's no money going into the reserve fund. The reserve fund policy dictates when that money can come out of the reserve fund. As Becky indicated, the first year, because there's a significant drop in the investment rate, anything over 2% on a year-over-year increase on the ADEC is coming out of the reserve fund. After that, any increase in the ADEC, and don't forget the debt service is constant, level principal and interest, but any increase over the ADEC, the town pays the first 5% increase. Anything over and above that comes out of the reserve fund. So we're not putting any more money back in the reserve fund, but we're allowing the reserve fund is going to be invested, but at a very, what's the word I'm looking for?
Conservative.
Conservative. Thank you. A very conservative rate. Thank you.
Yeah, I'm not disputing that. I just like to know, here's where the money's coming from. I'm used to seeing, plan numbers of where it is, and then did you hit your plan numbers? And so I'm just looking to see the cash streams. Are we making them, not making them? And it's helpful to see it ahead of time as opposed to just a lot of columns.
Yeah, and I'm sure that Chris provides quarterly updates on our asset growth or how we're doing. So, yeah, I mean, whatever you need, we'll put together. I just want to make sure we're both on the same wavelength here. Thank you.
That's fine. Then why don't I design something that would help, and then everybody can modify it from there. All right.
Thank you.
think that was all. Then again, if they're doing extra models, whatever the 70s was, because that had high inflation. I'm good.
Okay.
Thank you.
I want to return, though, to what I said at the beginning, which is that all of our analysis assumes that the liabilities change over time exactly in accordance with our actuarial assumptions. In a high inflation situation, wage inflation would cause the liabilities to go up. All right, so the model is only modeling different investment outcomes, not what might happen to wage inflation and therefore impact the liabilities under certain economic scenarios.
I was looking for just
So
a investment. I understand your point on the on liability side.
just want you to all understand the limitations, of what we've done.
Okay, good. This is Nancy Dean. Brittany, any questions from your corner?
No, I have no further questions. I think my fellow board members have asked a lot of great questions, and I look forward to seeing Becky's analysis from those.
Okay, all right. We do. I'm just thinking ahead here. We do have another meeting. Lori, correct me. The 22nd, I think, is it?
Yep, February 22nd.
And I'm wondering if, without putting undue burden on my fellow board members, if those of you, and I think it's probably Alan and Lazaro and to some extent Ethan, some of these additional things that you have some interest in. I don't know if there's enough time for you all to get that information to Becky or to refine it. I think Becky probably has a fair amount to start to think about here, as well as perhaps there are some ways, Becky, to give, it's hard for me to imagine scanning 10,000 scenarios of anything, but that if there is some way to extrapolate those that are the most negative early on in that investment horizon that we're looking at here, or the length of term of the bonds, that would be, I think, very tangible help to us in that level of comfort, or that as we're building our foundation to work with Chris. But if we could perhaps look towards maybe an estimate coming back from you, Becky, Milliman, as to what the cost would be to do all of this work, that to kind of translate what you're going to get input for. I think that would be wise for the board to know on the 22nd, if that does not put too much pressure. I think I see Alan, you're raising your hand for just a minute. I want to just be cautious of how much work we're putting on each of the parties here in a timely basis. So, Alan, did you want to say something?
Yeah, Alba, board member. What I'd propose is if Becky and I could have some conversation after this meeting, I can put together this 6 or 7 scenarios that we're talking about. Becky, you can confirm for us whether that, I assume that's rather cheap, that all we need to do is take those scenarios, plug them in, get an answer. I don't think that there'd be much expense with that. The other thing I guess would be really helpful to me anyway is to receive that file that you were just showing us, where you plug in the scenario number and see the results. That would be helpful to just have and be able to analyze. With respect to the other request about looking at different scenarios, that one I could understand. If that one could be some cost if I can't provide it to you in a format for your use. And so that one, again, we can have some discussion afterward and figure out whether that will be costly or not, and then should be ready to hopefully address the board on the 22nd. That's what this all would involve.
This is Becky. If all we're doing is taking Al's 6 or 7 scenarios and plugging them into the model and producing a PDF picture of those scenarios, the details. I expect that is not a big job. It's maybe $1,000, $1,500, something like that. I didn't entirely follow Ethan's request. I could certainly add more columns to what you see, so that you see some more of the details that we had otherwise hidden, because they're, it's already a lot of numbers, but we can add more. You want numbers, we've got them, and that might answer your questions. If there's something more than that, I would just need to better understand what it is you're looking for. If we're getting into other sets of 10,000 scenarios from other sources, that's much more costly. And I could see it easily running maybe $8,000 to $10,000 or more.
This is Nancy. I would think if we take the step approach here, that perhaps Alan and Becky can spend a little bit of time to get in a direct communication relative to what the input could be. That would be helpful. Assuming that those issues that Lazaro raised are also addressed in that part of it. So perhaps a quick call with Lazaro after Alan fills the floor, so to speak, then Lazaro, you could add any other at the time. So I guess I can make a motion. I will make a motion that is the process that we flow through, that we ask Alan to prepare some information and have a conversation with Becky that she can react to and work through the numbers, and have Lazaro's additional nuances built in. I'm going to pause that because I saw Ethan raise his hand, I think.
She doesn't need to run my scenario, but I'd be thrilled if she could run Ethan Golden, board member, if she could give the extra columns. So that's all I need. Thank you. I didn't mean to interrupt you, sorry.
That's okay. So I will make that motion that work be done between now and enough time to have us have something to digest and react to on the 22nd. Alan, before I finalize that, I should see you have your hand raised.
Yeah, I just, at the beginning of this meeting, we talked about, communications between board members. And I just want to make sure in putting together these scenarios, Lazaro has some requests. Is there any issue with me speaking individually with Lazaro to go over exactly what he wants to put together? And is that a permissible act?
I'm not an expert in freedom of information or what some of the concerns are in that regard, but I think at this point I might prefer that you have a conversation directly with Becky in terms of achieving what it is that you want. You did do a very good job at kind of that baseline set of variables and alternatives that you outlined in your email, and perhaps then once that is built in or in Becky's hands relative to how that would be processed, we could have her communicate through Peter, but then we'll have Lazaro take a look at that as well. I want to proceed very cautiously. I appreciate your asking that step. It sounds redundant and it sounds more labor intensive than perhaps, or more cumbersome than any of us are used to, but I think we do need to be very, very, very careful, and having had a few conversations with Corporation Counsel, I am trying to err on the side of caution here. Okay. So thank you for asking that, and sorry if it's 3 calls instead of 1, but so be it. So I've made that motion that we will move forward then with additional analysis with Alan to speak with Becky. So all those in favor, please say aye. Lori, could you do a roll call of that? Thank you.
All right. Lazaro Guzman?
Aye.
Al Lebo?
Aye.
Ethan Goldman?
Aye.
Brittany Birmingham?
Aye.
Peter Privitera,
Aye.
and Nancy Dean.
Okay, aye. Okay, thank you. It was an awkward motion, but I think just so that we keep ourselves moving on track in this regard, and I did want to, I think a couple of you, or at least one of you has a commitment at 9 o'clock, so I want to be very cautious and respectful of that. So I would thank Becky, thank Chris, who has been silent mostly this morning, but thank you for being here and absorbing actually all of the different things that we're concerned about here from the investment side. As our counselor, you need to be our advisor and hear all of what we are concerned about. So with that, if there are any other questions before I adjourn the meeting, anyone? Ethan?
So are we going to be able to get the, I'm sorry, Ethan Golden, board, pension board member. Are we going to be able to get the extra columns for that spreadsheet, or at least, because I'd be interested in that.
This is Becky. Yes, we'll add the extra columns to the output. Al did ask a little moment ago, could he actually get the model to plug in different scenarios? And the answer is no, we can't release that without your
Proprietary, wouldn't it?
It's way proprietary. I would be happy to have in meetings like this the ability for me to pull it up and show you different scenarios, but I can, and then the gory details behind the scenes as I sort of briefly flash up for you, but I can't provide you with the model itself.
So if you could set the extra columns, that'd be great. Thank you.
Alan?
Yeah, we both board member. So I just want to distinguish between what you're saying as the model and what we're talking about as the output of the model. What you showed us was, the column outputs where you could change scenario by scenario. That's not the inner workings, not the how the model works inside of that produces those answers. That can't be provided.
This is Becky. I can provide you with a PDF file that shows you the output, and I can add a whole bunch of columns to it. But I can't provide you, I can't email you the model itself that allows you to input different scenarios on yourself. I can run it, but I can't send it to you so that you can run it.
Okay.
Okay, good. Peter, any closing words before I?
Yeah, I just wanted to let everyone know that process is moving along. All the required information was sent over to the state of Connecticut for their review. So our time frame, once we sell the bonds, is to close probably the first week of July. So we have time to do the analysis and make final decisions on, the time period for the dollar cost averaging. We're not going to have to make a decision on this over the next 6 to 8 weeks. We have time. So I just wanted to point that out. Thank you.
Yeah. This is Nancy. Yes. Thank you for that. It's just that, I think we are also deeply wanting to understand and get a feel for it that, and then start to do the permutations with Chris. But thank you. It is good that that is not coming to market on April 1. That's for sure.
And this is Becky. We will attempt to get the information back to you by the meeting on the 22nd, and let me know if you need me at that meeting.
We will do that. Thank you for that offer. All right. Thank you very much. All right, then I will adjourn the meeting, and I thank you all for your attention at this morning's meeting, and we'll see you shortly. Thank you.
Bye-bye.
Bye.
Bye.
Bye.